Welcome to the Deep Dive. We're the show engineered to, well, cut through all that noise out there and get you the real story. Especially with financial news, right? It feels like one day everything's great, the next doom and gloom, and making sense of those signals. It's tough. So that's what we do. We take your sources, pull out the crucial bits, and basically give you a shortcut to being properly informed.
Exactly. And this week's source material, a market outlook for August 12th to 18th, 2025. It's a perfect example. Yahoo Finance put it well, saying the economic data resisted attempts to construct a clean narrative of where things are headed. So our job today, our deep dive, is to unpack that resistance, figure out why it was so messy, and see what patterns maybe still popped up.
Okay, let's get into it. It was a really fascinating week for data, and it started really with inflation. First big update was Tuesday. The Consumer Price Index, the CPI report, it actually came in right on expectations, up just 0.2% for the month. And the year-over-year core CPI, it's the one without food and energy, it was a little bit above expectations, 3.1%. The markets, they took it pretty well initially. The thinking was, okay, a Fed rate cut in September, maybe 25, maybe 50 basis points, that's still on the table.
Right. But then came the twist. Thursday, we got the Producer Price Index, the PPI. Now this tracks what companies are paying, their input costs. And it came in very hot, like 0.9% for the month when everyone expected a 0.2%. That was a 3-year high. And just like that snaps fingers, any talk of a 50 basis point cut in September, gone. Poof. Quite a shift in, 48 hours?
Wow, yeah, that's a major reversal. So, okay, you get a PPI number like that, it's so much harder than expected, especially after CPI seemed kind of tame. How do you even start to figure that out? Our source material laid out, two main ways people are looking at it. Angle one, maybe those tariffs we keep hearing about are finally biting hard on company costs. Materials, components getting pricier. And the worry there is, companies might eat those costs for a bit, but eventually they pass them on to us, which means higher CPI later, and maybe people buy less stuff, so lower retail sales.
That's definitely one possibility, a valid concern. But there's another way to see it, and frankly, it seems like the market kind of leaned this way. It's the fact that PPI, historically, it's just way more volatile than CPI. More than twice as volatile, actually. So the question becomes, is it smart to put too much weight on one single jumpy report? And maybe the stock market's reaction, which was, surprisingly calm after that huge PPI number, maybe that suggests investors thought, okay, this is probably noise, volatility, not necessarily the start of a big consumer price surge. It's like the market saying, hold on, let's see more data before we panic.
Okay, that makes sense. Sort of looking past the headline number. And speaking of the consumer, Friday gave us more pieces of that puzzle. 2 reports. First up, retail sales. They grew 0.5%. That was actually a small miss. The expectation was 0.6%. But, and this is important, it was the second month in a row they grew after falling the 2 months before that. So really mixed, right? The consumer spending, but maybe not, enthusiastically.
Exactly. Mixed is the word. And then the other report, the University of Michigan Consumer Sentiment Index, that one raised more flags. It came in at 58.6. The expectation was 62. So a noticeable miss. Now, context is key here. It's still quite a bit better than the lows back in April and May, but it does suggest maybe some weakening, some worry creeping in for consumers. And the really crucial bit, both short-term and long-term inflation expectations from consumers, they jumped way above what was expected. But for the Fed, that's a big deal because if people think prices will keep rising fast, it can, make it happen.
Right, the self-fulfilling prophecy idea. So, okay, calm CPI, then bam, hot PPI. Mixed retail sales, but consumers worrying more about future inflation. How did all this messiness affect what people think the Fed will do with rates? Well, after that PPI shocker, the odds of seeing rate cuts bigger than 50 basis points by year-end, they dropped from about 44% down to 33%. But perspective is important here. A huge majority, like 98%, still expect the Fed to cut rates at least once before the year's out.
Which brings us to the big question mark. What's the Fed actually thinking? What will they do? And those expectations could shift again pretty soon. We've got some key Fed events coming up this week. Jerome Powell is giving his big annual speech at Jackson Hole. That's on Wednesday. Our sources are calling it maybe his most anticipated speech of the year. Potentially his last one there as Fed chair, too. And also on Wednesday, we get the minutes from the Fed's July meeting. That gives us a look inside their discussion then.
Okay, so lots to watch there. Now, the part that might make you scratch your head, the markets. With all this conflicting data, this uncertainty, that hot PPI, how did stocks react? They went up. U.S. stocks hit new highs last week. The S&P 500 actually crossed 6,400 for the first time ever. on Tuesday. And it wasn't just the S&P. Growth stocks, the Nasdaq, they set records too. It just feels odd, doesn't it?
Yeah. It really does seem counterintuitive on the surface. And an even more interesting signal came from small cap stocks. Now, they're not near a record high like the big indexes, but they had a very strong week. We watch these different segments, large cap, small cap, growth, value, because they tell different stories. Small caps, smaller companies, more focused on the U.S. economy. They're usually really sensitive to interest rate changes. So look what happened. They jumped up right after that OK CPI report because it kept rate cut hopes alive. Then, they sold off a bit after the hot PPI, as you'd expect. But even with that dip, they still ended up being the best performing U.S. stock group for the week. Just to give you the numbers, large caps up 1.2%, small caps 3.5%, growth 1.0%, value 1.7%, and the Nasdaq 1.1%.
Wow, 3.5% for small caps. That is strong. And it wasn't just a U.S. story either, was it? Looking globally. Developed market stocks, they were up 2.3%. Emerging markets up 1.9%. They actually did better than the U.S. overall. And developed markets even hit a record high on Friday. So strength across the board, really.
Yeah, absolutely. And one place that really stood out was Japan. Exceptionally strong week there, up 4.5%, closed at a record high. And get this, it surged over 40% just since its low point back on April 7th. That points to, a real appetite for certain global markets, maybe some specific regional strength.
Incredible run for Japan. Okay, and quickly, bonds and rates. How did they play out?
Pretty much textbook reaction, actually. Bonds rallied when CPI came in, okay? More hope for rate cuts means bond prices usually go up, yields down. Then, when PPI came in hot, bonds sold off. Less hope for big cuts means yields tend to rise. So for the week, the 10-year Treasury yield ended up rising 6.8 basis points, closed at 4.34%.
Okay, so let's bring it all back.
Yeah.
We started by saying the data this week, quoting Yahoo Finance again, resisted attempts to construct a clean narrative.
Okay.
We had CPI saying one thing, PPI screaming another, mixed signals from the consumer. So how on earth did stocks especially just seem to shrug it all off and hit new highs, particularly that PPI number?
Well, connecting the dots, it really looks like the market focused on that second interpretation of the PPI. The idea that, yes, it was hot, but PPI is volatile, it jumps around. So maybe don't read too much into 1 month's number. It shows how the market can be, selective. It filters the information. It's not just about what the data says, but why the market reacts the way it does. What story is it choosing to believe? And in this case, it seems the market decided that one surprisingly high PPI reading wasn't enough to derail the bigger picture, or at least the hope for some kind of Fed easing down the road.
Right. So in this flood of daily, weekly economic updates, what this deep dive really highlights is that sometimes the key takeaway isn't the data point itself, but how the market, the collective wisdom or maybe bias of investors interprets it. Especially when you get these really conflicting signals. It's about the narrative the market built.
Which leaves us with a final thought, doesn't it? If the market is so good at filtering data, at crafting its own narrative, even when the numbers are all over the place, how much weight should we really give any single economic report when trying to understand the big picture? And what does the market's apparent confidence, writing its own script amidst the confusion, tell us about where things might actually be headed next?